Welcome to Prof K Analysis. Today our topic of macroeconomics is money analysis. Today our topic of macroeconomics is money and banking, and this topic is relevant for all of us as we all the day we are dealing with our money as well as we have to deal with our banks because every one of us has a bank account, so we have to deal with the banks. We divide this whole topic into four subtopics, in which first we will talk about the nature of money, how we define money, what are the functions of money, and the evolution process of money, that how the money evolves, because it's not from the very first day what the physical notes we have as a money nowadays, or the cards we are using as a money is not from the very first day of the invention of this money is working. So it's evolved over a period of time from a seashell to the commodity money, and then gold metallic money, and then we have a paper money, and then we have a this plastic money which we call it as a card. The Canadian banking system, the second topic we're going to talk about the Canadian banking system, in which we mostly talk about two major players of the Canadian banking system. One is the Central Bank of Canada, which we call it as a Bank of Canada, and the second one is the financial intermediaries, or those who are working as banks or commercial banks, as well as some other finance companies. Those are operating in a way to collect deposits and lend money, like a trust companies or mortgage financing companies. Then the third topic is money creation by the banking system. So we all know that our banks where we deposit money, they are working on a fractional reserve system. Fractional reserve system, and they create a reserves out of deposit, and rest of the money they lend it, or they use it for investment purposes. And this is the way that the banks generate their income. And if they are not lending money, so they cannot generate income out of it. So they are not just working as a safe deposit or just to protect the money. They are working as a get the deposits and lend it, but they have to keep certain proportion or a certain fraction of their total deposit as a reserve, so that they can meet the demands of the depositors when they want to withdraw the money. So that's a money creation system by the banking system. And the third thing that we're going to talk about, the money supply. So with the bank, the Central Bank of Canada, the Bank of Canada have the information that how much money is circulating in the economy, and they also have to measure that in numbers, so that they can develop the policy according to the requirements if the inflation, and they have to meet their inflation targets. So we will talk about the various measures of the money supply. So let's see, in this slide I put this a new $10 note of a Canadian currency. This uniqueness about this $10 note of a Canadian currency is that this is the first currency note in Canadian history that is vertical. It's not mostly the notes are horizontal, like in this shape, but this note has a vertical, and it's also uniqueness that we put a lady photograph on it. So that's a function of a money. What are the main functions of a money that we see that money is performing? They work as a medium of exchange. So whatever we want to buy, what we do in return of that, we pay the money, and we get it. So this work as a very efficient medium of exchange. If we want to pay back our loans, we have to pay in money. So the money is working as a medium of exchange. But keep it in mind that money, the Canadian currency or a Canadian money is operating within the Canada. If we want to make payment in any other country with the Canadian dollar, so may they responded not to accept it. Then what we have to do, we have to convert it into the local currency of that country where we want to spend it, and then we can make payments. So the acceptability of a medium of exchange for each currency is mostly limited, except the US dollar or some other big currencies is limited to their own geographical boundaries. Like if you want to spend a Indian rupee here, so maybe some traders or some shopkeepers may be gonna accept it, but in general it is not going to be acceptable. Then what is the solution? That you have to go to the money changer and then you exchange it into the Canadian dollar. So that's one thing, that they work as a medium of exchange. The second thing, that they are working as a store of value. Like if you keep $100 under your mattress or under your pillow, and after a month or after a year, it's going to be also $100. It's not going to be depleted, or although the value may be going down because of inflation, but it is going to be $100. It's going to be $10, whatever the amount you get. So we store wealth. We store our wealth in terms of the money, or the value of the money. This third factor, that's a unit of account. It works in a measurement of anything, any value. Like we normally ask that, okay, what is the value of it? So normally the people replied in terms of dollars, like $100 or $10,000 or $100,000. The worth of any asset or any thing that we want to assess, we assess in terms of money, like a $1 or a 1 cent or a. So by this way, we see that it works as a medium of exchange. You can see all the balance sheets or income statements of all the big corporations, even very small businesses, individuals. We all are measured our things, our assets, our liabilities in terms of money, in dollar terms. So that's the way that it works. It helps us in. If it is not possible, then it's very hard to measure. Like if you go to the shop, you can find out each and every item in any store or a place where you buy things. You see that every product has its price, and price is in dollars. So that's going to give us a good idea that how much we have to pay to buy that. So if that's not the case, then it's very hard to measure the things in terms of multiple different items. So this way we see that money need not to be physical now. Right nowadays, we see that because of a technological improvement in our banking system, we don't need physical currency. In olden days, people have a lot of physical currency. Their wallets are full of currency notes. But nowadays we don't need it. Why we don't need it? Because now make the system possible that we have a money at our bank, but whenever we want to spend it, we can it by the help of our debit cards. So money needs not have a physical presence to serve as a medium of exchange, as a store of value, or a unit of account. Most Canadians hold much more money in their bank accounts, like very normal, and they can easily make a transaction with a debit card. So we, up till now this point, we are saying that debit cards are the only money, not the credit card, because credit card is not treated as a money. It's a borrowing. It's a lending by the bank or the credit company, and it's borrowing by the consumer or the one who is spending the money. So in the overall economy, there is a much more money in the form of a bank deposits. So bank deposits are also treated as a money because we can use it at any time with the help of our cards, or online we can do it. So then there is in the form of a physical money. Now we see that the money was originated from seashells. So if you read the history of a money, you can find out different stories, different descriptions. So if I very precisely explain you that how the money started. So it started with the seashells and all these commodities which are rare, and people can count them, and then they can assess the value, or they can assess their genuineness. So by this way, you can see that money started from seashells, then converted into and in the period it works as a barter, as like a many commodities like a wheat or a maize or a grain. They also work as a money because they pay the things in that term and get the services and the other goods in other goods and services with the help of. So we call them as a commodity money, like a commodity, using different commodities as a money. So let's share with you a story. Like in the World War, the prisoners of war in the some prison, they get some supplies. They don't get any money, but they get supplies as a standard for a prisoners of war. So for a prisoners of war, under the Red Cross or under UN Charter, every prisoner of war has a right that they will get some commodities or some supplies of cigarettes, razors, and some very basic needs of any human being. So when we see that in a one prison, the people start exchanging like a coffee or a tea, some quantity of tea, coffee, cigarettes, razors, some cookies, and these are the basic supplies every prisoner is getting. But everyone is not consuming everything. So what they do, they exchange. So the one who loves tea, they buy tea by exchanging with the coffee or with the other commodities or other things that they have. So we see that at some later stages, we find out in this story that the cigarettes become the money for them. Like they exchange the things in terms of cigarettes. Like, okay, what is the price of a one tea bag or a one coffee bag? Is four cigarettes or five cigarettes. So by this way, they convert the cigarette as a money to exchange goods. So that's a one story, and this is not the fake story. It's a real story. Someone observed in the prison that how the prisoners are exchanging things with this. So that's an invention of a money within a very closed prison. How they develop their own currency. So then, because then there is a milling starts, and then they start minting currency, coins, and this coins of every country or a region or some their kingdoms, they start issuing their own coins. So that's a start of a metallic currency. But again, the goldsmith comes into action before the start of the central banks in different countries. Goldsmiths, so what they do, they provide the services to the people so that they can deposit their golds with them, and in place of the gold, they issue some paper receipts that they have this much gold with us. So then they use they instead of taking the gold from the goldsmith and take it to the market to buy something with the gold, so they just give them the receipt that okay, my gold is with that goldsmith. So in place of giving original gold, I can give you the receipt of that goldsmith, and if you need, you can go to the goldsmith and you can exchange this receipt with the gold. So by this way, they starting a paper money from the metallic to the paper money. But as you know that these are private arrangements, so maybe sometimes the goldsmith's gonna be defaulted or become bankrupt. So by this way, there is always there is a mistrust, or there is no 100% confidence on the paper currency. Because some goldsmiths issue more receipts as compared to what the gold they have. So by this way, there is some problems arise. Gradually what happens, like from this goldsmiths to different countries or societies, they start their own central bank under the government, and the central bank's role is that they have to issue the currency. Initially, before the world wars, there was a gold standard, like the central banks keep the gold and issue the currency against that gold, and by this way we call it as a gold standard. So gold standard working in a way that the central banks have a gold and they issue receipts on that behalf, and those what we call it as a currency notes, but backed by 100% gold with the central banks. But later on, as the economies grow after the World War, rehabilitation or reconstruction of the economies, especially in Europe, so what they start feeling that the quantity of gold is very limited, and it is not possible that they can issue more currency, and there is a demand for money in the economy. So they start issuing more than the gold, and they abolish this gold standard. And then comes to the point that okay, they say that it's a fiat money. Now there is a very specific definition of a fiat money. Fiat money means that it is the money, and why the people are accepting it, because there is a law behind it that you have to accept it as a medium of exchange or as a means of payment. Either you are paying for something or you are paying for your loans. So it's a legal tender, or you can say that it's a fiat money with a legal tender that no one can deny. Like if you are selling something and the buyer of that product is saying, okay, I want to make you payment in Canadian dollar, so you cannot refuse under the law, and that's the quality of a fiat money is. So from a abolition of a gold standard, we move toward the fiat standard. Or still up till this point, the most of the currencies are fiat currencies or a legal tender that they have to accept it as. There's a Gresham's law. There's a side, like if there are two currencies operating in any economy, so the poor quality currency is going to stay in the economy and the good quality currency is going to be going out. And then you can understand this law with the very simple, like you have a 10 currency notes of a $10 or a $5 or 10. It's a human nature that and you have to make a payment, so you will pay the dirtiest one the first. You want to get rid of the dirtiest one first, and that's the way that human nature works. So we want to use or consume first our poor quality notes or a poor quality money. So if in any economy, if there are two types of currencies are operating, so the good quality currency, the people hold it, and the poor quality currency is going to operate it in the economy. Now, if we look from right now, what is going on in the economy, so we see that we further advanced from the plastic money or a card money towards the what we call it as a Bitcoin or other types of cryptocurrencies. So that's another way that money held by the public in the form of a deposits with the commercial bank, we call them as a deposit money. Bank deposits are considered 100% as a money. Today, just as in the past, banks create money by issuing more promises to pay deposits than they have a cash reserves available to pay out. So as I mentioned in the beginning, that there is a fractional reserve system that they get for example, a bank get a deposit of $100, so he's not going to keep $100 in order to pay the depositors 100. So he expect that, okay, depositors only claim going to be about $10, so he's going to keep reserves of a $10 and lend the $90. So the one who is getting this $90 is supposing that this is money available to them, so it's creating a $90 money for them. So then the one who is having a $90 is not going to keep all the money with himself as a currency, so he's going to keep it in his bank, and so this creates another deposit of a $90. So out of this $90, if the bank is feeling that they have to keep 10%, so it's going to keep $9 and then lend the remaining $81. So by this way is going to creating money, and we will talk about in detail in the coming slides. Another modern form of a money is, as I mentioned, cryptocurrencies such as Bitcoin, Ethereum, and Ripple. Now, the Canadian banking system, as I mentioned, are two types of institution make up a modern banking system. One is the central bank, which in our case is the Bank of Canada, and the second one is a financial intermediaries. Financial intermediaries. Why we are saying it is financial intermediaries? Because they are working as a middleman between the one who is saving the money or those who have an excess money and those who are in need of money, borrower and lender, right? So they are bridging or working as an intermediary between the borrower and the lender. So the lender is the depositor, so he is depositing the money in the bank, and the borrower is the money who is getting the money from the bank. So that's the way that it works as a financial intermediaries. So commercial banks, one of the financial intermediaries are the commercial banks. Refer to the financial intermediaries. They are deposit accepting and loan granting. Now, the Bank of Canada, the history of the Bank of Canada. So as I mentioned that after the gold standard, after this goldsmith scenario, like those who are issuing this receipts, every country is establishing their own central bank. So Canada also established his first central bank, the Bank of Canada, on March 11th, 1935. So it's not so old. It's around a 90 years old story of this bank, which is the Bank of Canada. The organization of the Bank of Canada is designed to keep the operations of monetary policy free from day-to-day political influence. So I mentioned many times during the class and other chapters that there are two main policies we always discussed in macroeconomics. Two main policies. There are a lot of others, but two main policies. One is called fiscal policy, and the other one is called as a monetary policy. So these comes under two different perspective. Like monetary policy is the job of a Bank of Canada. So as a central bank, they are responsible for making, implementing, and also designing the whole policy framework for monetary policy. On the other hand, the government, the government of the country, like whoever is in power, they are designing the fiscal policy. So now the Bank of Canada is have a autonomous in a way that they can design the monetary policy according to the economic situation or economic requirements of the country. So they are not under the political agenda of the present government, but they are designing the monetary policy according to the requirement of the economy. So the Bank of Canada has considerable autonomy, but the ultimate, definitely, it's not a country within a country, but it's a country who is coordinating. Ultimate responsibility for the bank's actions rest with the government. So the system is known as joint responsibility. So it's a joint responsibility of a Bank of Canada and the government of Canada. The basic functions of the Bank of Canada is mainly three. What is the main functions? One is that bankers to the commercial bank. So they are working as a bank towards the commercial banks, like all the commercial banks like TD Bank, BMO Bank, Scotia Bank, or RBC. These are all commercial banks. They are operating under the umbrella of Bank of Canada. So they are working as a bank to the commercial bank. So these banks have their account with the Bank of Canada. So normally individuals don't have an account with the Bank of Canada. So we as a common citizen, as a individuals, we don't have an account with the Bank of Canada. We have an account with the commercial banks like a TD Bank or a BMO Bank or a Scotia Bank. And these banks have the account with the Bank of Canada. So they are working as a banker to the commercial banks. The second thing, they are working as a banker to the federal government. The government also have their accounts with the Bank of Canada. So they normally keep their main accounts of the federal or the provincial governments with the Bank of Canada. So they issue checks with the respect of a Bank of Canada. The third thing, they also work as a regulator of the money supply, or you can say that it is their responsibility to develop the monetary policy or to implement the monetary policy. Now, if you look at the balance sheet of a Bank of Canada, so it's just to understand that how we differentiate the Bank of Canada's balance sheet from a normal. So you see here the Government of Canada securities. That's the main asset of the Bank of Canada. So the Government of Canada, when they borrow money, what they do, they issue bonds, and the Bank of Canada buy those bonds, and then later on they sell it to the commercial banks and other major investors. But the main thing that they work as the Government of Canada's securities. So this is an asset side, and the biggest item on the asset side of the Bank of Canada is government securities, the Government of Canada's securities. The rest of the things, you can say advances to commercial banks, that they lend money to the commercial banks, is zero. Net foreign currency assets, like the Bank of Canada has foreign currency reserves as well, like they have a Japanese yen in the Tokyo account. They have escrow accounts in Tokyo, or they have an account in New York with the dollar accounts, US dollar accounts. They have an account in pound sterling in UK. So the central banks have their accounts in different countries with the different currencies. So that's what we call it as a foreign currency assets. Then the other assets means that the buildings and the other furnitures and all these things that Bank of Canada has. Bank of Canada has a big establishment like a operation. So they have assets. So we report it as other assets. On the liability side, the biggest liability is the notes in circulation. So you see, if you look at your currency note, like a $5 bill or a $10 bill, so you see that it is the liability of the Bank of Canada. right? It's not mentioned as a government of Canada, but it is a Bank of Canada. So notes in circulation is one of the largest liability for a Bank of Canada. Then Government of Canada deposits, like they receive, we just mentioned that they work as a banker to the government, so that's a Government of Canada's deposits. Deposits of commercial bank, they also work as a banker to the banks, so that's the deposits of the banks, and other liabilities and capital. So we can see that there are some other liabilities as well as the capital of the bank. So we look at the situation under the pandemic or COVID-19. So beginning early in 2020, the Government of Canada issues a massive amount of new securities to provide financial reliefs to unemployed workers and businesses whose revenues had collapsed. So in 2020, during the peak time of a COVID-19 pandemic, the Government of Canada borrowed a lot of money. And how they borrowed? They sell the security Government of Canada securities to the Bank of Canada and take the money in order to use those money to bail out the businesses so that they cannot lay off the people, and that's the way. The Bank of Canada played an important role by purchasing a large amount of these newly issued securities, thereby expanding the amount of money in the banking system. And that's the reason you see that there's a lot of money supply, as well as they reduce the interest rate. So during the COVID-19 period, the interest rates was very low. With the arrival of vaccine in early 2021 and the swift recovery of the economy that followed, it expected that the Bank of Canada's balance sheet returns to a more normal situation by 2022 or sooner thereafter. Now, commercial banks in Canada, as I mentioned, two financial institutions, mainly the Bank of Canada and the commercial banks, are privately owned, profit-seeking institutions that provide a variety of financial services, such as accepting deposits from customers. That's the main job of the commercial banks is, and providing loans. And we see that their main source of income is the interest they pay to the depositor, and the interest they charge to the lender, a borrower. The difference, we call it as a spread, and that's the main source of income for them. Spread, the difference between the interest rate they charge to the borrower and their interest they are paying to the depositor. The difference of this 2%, that's the main source of income for banks. Although they also provide some other services like transfer of money or deposits, safe security boxes, and all these type of services they provide. Essential intermediaries in the credit market undertake interbank services, and we know that we are operating with the multiple banks, like not a single bank. So when there's a multiple banks, so there is a need of a clearinghouse. Now, why we need a clearinghouse? Because at the end of the day, every bank has received many checks, which is drawn on other banks. Like a BMO get a check from TD Bank, or a check of a TD Bank from his customer, but ultimately they have to receive the money. So what they do, they collect the money, all these checks, and they send it to the clearinghouse. The clearinghouse clear these checks from each other banks, and they find out at the end of the day net position, that how much the money each bank is receiving or paying. So by this way, they settle down the accounts at the end of the every business day. So they settle down their accounts. That's what we call it as a job of a clearinghouse. Commercial banks also act as a profit seeker, and that's the reason that the private sector, private owned and seeking profit, that's the main objective of establishing a bank is. Now, commercial banks works under fractional reserve system, like they get some deposits, so keep a certain portion of that deposit as a reserve and lend the remaining amount. So that's, we call it as a fractional reserve system. Then we have a reserve ratio, like how much percent they are keeping as a reserve, like a 5%, 10%, 20%. These are called as a reserve ratio. So in Canada, normally central banks have give the reserve ratios, like every bank should have to keep 10% of their deposits as a reserve. But in Canada, there is no such compulsion. So every bank is establishing their own target reserve ratio. And whenever they have an excess reserve over the target, so what they do, they start lending, and they want to lend it, because their main source of income is the interest rate they earn from their loans. So at the core of any commercial banking system lies the both confidence and risks. So banking system is a very much based on how much trust people have on their banking system. If the people have a trust, so they deposit their accounts, their money with the banks. If they don't trust, then what they do, they prefer to keep it at their homes. And if they try to keep at homes, then this process of money creation is not going to take place, and the borrower, those who are looking for a loan in order to do some economic activity, some businesses, and some type of manufacturing or producing, that is not going to be happen. So that's a way that banking system is very important, and also very dependent on the trust of the people. So money creation by the banking system. So some simple assumptions. We are making some assumption in order to understand this money supply creation system more easily. To focus on essential aspects of how commercial banks create money, suppose that banks can invest in only one kind of asset, loans, and they only one kind of deposit. So in order to simple, although the banks have a very different types of deposits, and their reserves requirements or the fractional reserves for each type of deposit is different, but here we are simply assuming that there is a one type of loan, one type of deposit. We assume all banks have the same target reserve ratio, which does not change, and then there is no cash drain from the banking system. So we are also assuming that every bank in the system has the same ratio, target ratio. And also we are assuming that there is no drainage, like the people are not taking cash out of it. So they are only creating their bank deposits. So you see here, the first step, we are saying the bank initially has a reserve ratio of 20%. So they say that their target reserve ratio is 20%. They want to keep 20% of their deposits as a reserve, and lend the remaining 80% as a loan. So here we see that the bank has the initial balance sheet of a TD bank. So we see the bank has a deposit of 1,000. They have a capital of 100, and against the 1,000 they have to keep 20%. So it means 200 they have to keep as a reserve, cash, and then they can lend 900. Why they are 900? Because you see that the liability side is capital plus deposits is 1,100. So out of which they have to keep 200 as a reserve. So the remaining 900 they can lend. So they lend it. So that's why there is a deposit of against the deposits of 1,000 plus capital of 100. They lend $900. So one day what happens, like a new deposit of 100 raise the bank's reserve ratio to 27%. Now they get a new deposit. So what is a new deposit is of $100. Now how much the deposits they have? They have a deposits of 1,100. Now out of 1,100, so definitely when they have receive a deposit, so they put it on the balance liability side as a deposit, but they also have a cash because someone is depositing it. So their cash and reserves is going to be increased 300. So against the $1,100 deposits, they have a reserves of 300. So if we calculate the ratio, so it's going to comes at 27%. But what is their target? Their target is 20%. So it means that they have a 7% excess. So what they do? They lend it. They lend it. So we see here. So total is 1,200. This is going to be a little bit typographical error. So we see here. It's a 1,200 total, but deposits are 1,100. 100 is capital. Altogether 1,200, and on the other asset side we have a 220 as a reserves. 20% of 100 is 20, so 220 we have a reserves, and the remaining 980 is we are creating a loan. Now the second round, bank receives 80 in a new deposit. So we lend this 80. This 80, again we are assuming that they are keeping this as a deposit. So the one who borrowed this $80 is going to deposit in the bank. So when they get this $80 deposits, so you see here they get a additional $80 deposits, and what they need to do is they have to keep 20% of 80, and what is it? 16. So they keep the $16 as a reserve and lend the remaining 64. So if this process continues, like every time they keep 20% and then lend the remaining, So we see that with the initial deposit, just an additional deposits of 100, how much money is going to create it? 500. So you see here, it's 446.33, but it can continue still because there is some reserves are possible. So we see how much additional reserves we create, how many new loans we create, and how much the total deposits is going to be increased by just 100. Why? Because it's a uh, and this is the way what we can see that the sequence of loans and deposits after a single new deposits of, so just an addition of $100 going to create in the economy around 500 or 450 dollars money in the system. So it's multiply. That's what we call it as a multiply. So the creation of deposits. So we see that how this deposits is going to increase. So if V is the target reserve ratio, like in our case, what we discuss or what we discuss as an example is 20%. A new deposit to the banking system will increase the total amount of deposit by 1 over V times the new deposit. So we can say that how much is the multiplier? 1 over V times. So in our example, V is 0.2 and the new deposit is 100. So the total deposits eventually increase by 100 into 1 by 0.2, which is 500. So that's a total deposit eventually increase by $100. So with no cash drain from the banking system, a banking system with a target reserve of V can change its deposit by 1 over V times any change in reserve. So we can see this is the way that we can calculate the change in deposits. So the total change in the combined balance sheet of entire banking system is going to be 500. So 400 for the loans, 100 reserves, and on the other side 500 deposits. So it's a total increase in money supply with the new addition is 500. So with a 100 we can convert it into 500. So deposit creation depends on the decision of bankers. Now this is all depends on bankers, like how much they want to keep as a reserve ratio, because as I mentioned, in Canada we don't have any compulsory or a mandatory reserve requirement. So it's all depend by the bankers. If commercial banks must choose to lend their excess reserves, otherwise no deposit expansion. So if people decide to hold an amount of a cash equal to fixed fraction of their bank deposits, any multiple expansion of our bank deposits will be accompanied by a cash drain. So cash drain means if the people are getting cash out of their deposits, then it's going to be reduced. So if C is the ratio of cash to deposit that people want to maintain, the final change in the deposits will be given by new cash deposits divided by C plus V. Now C is the cash, they want to keep it as a cash instead of deposits. Now the last thing, as we mentioned, the money supply. The money supply is the total quantity of money that is in the economy at any time. So economists use several alternative definitions of money supply. Each definition includes the amount of currency in circulation plus some types of deposits of liability and the financial institutions. So money supply is currency plus bank deposits. Now it all depends, like we define it these in a very technical terms, M1, M2, M1 plus. Now in M1 or M1 plus, so one thing is that we add up all the currency is in circulation. So it means the currency in circulation means the currency in the hands of public plus the currency in the commercial banks vaults. But the currency in the central bank vaults are not in circulation. So that's a currency in circulation plus bank deposits. Now it depends, like if we are talking about M1, that what type of bank deposits are included. If we are talking about M1 plus, then what type of bank deposits are included. But currency in circulation is going to be added up in all the cases. Now there are different types of deposits we see with the commercial banks. Demand deposits, like if you open a account with the demand deposit, it means that you can withdraw your amount anytime from the bank 24 hours. So you can withdraw the money. Saving deposits are those deposits in which there is a limitation that you can do this much transactions of this much value over this period of time. So these with certain restrictions over the demand deposits converted into a saving deposits, and that's why they pay higher interest on saving deposits as compared to demand deposits, because Term deposits, those deposits are for a very fixed term, like a 3 months, 6 months, 1 year, 5 year, 10 year. These are fixed, and if you want to withdraw your money, you have to pay a penalty of it. So that's why these are called as a term deposits. Money market mutual funds are those mutual funds which are generated by the money market. So money market is the market in which these main commercial banks as well as large corporations are operating together. Every day they are borrowing and lending for a very short period of time. Individuals not normally operate in this money market. If there's any mutual fund created in that market, that's what we call it as a money market mutual funds. Money mutual funds are those in which the people contribute or pool their resources, and then they buy some other assets through which they earn money. Money market deposit accounts, like those who are borrowing and lending against their deposits with the Bank of Canada or other corporations, that's what we call it as a money market. Now, as I mentioned, the technical names of this money supply monitor aggregates, so we call it as a money aggregates, is M2 and M2 plus, or M1, M1 plus, or M0. So M0 is a currency in circulation, M1 is currency plus demand deposits. So M2 is currency plus demand and notice deposits. So when we add up the notice deposits, then it becomes M2. And for M2 plus, similar deposits at other financials. So M2 is currency plus demand and notice deposits at commercial banks. So when we add up this demand and notice deposits at other financial institutions like a trust companies or Caisse Populaire, that's a French name of a TD. TD Bank was initially the Caisse Populaire. There are some trust firms, or there are some mortgage firms. So their basic is very specific to one particular type of instrument of financing. So that's these are the financial institutions. So when they are getting deposits and their deposits are added up, then it becomes M2 plus. So there are some money which are not actually a money but very close to the money, and we call them as a near money. Is a liquid assets that are easily convertible into money without risk of significant loss of value. Near money can be used as a short-term stores of value but are not themselves medium of exchange, like certificates or bonds, some government bonds. Term deposits are an example of a near money, like a certificate of a term deposits. A money substitute is something that serves as a medium of exchange but is not a store of value. An example of a money substitute is a credit card. So in the beginning I mentioned that credit cards is not a money, but it is a substitute to the money because it's allow us to buy things or work as a medium of exchange. So the role of a Bank of Canada, we have seen how the commercial banking system, when presented with the new deposits, can create a multiple expansion of bank deposits. So this shows how the reserves of the banking system are systematically related to the money supply. So in coming chapters, we're going to talk about the monetary policy, and in the monetary policy, we'll talk about how they control this money supply. Even with the banks have a capacity to create money that the central banks want to play. So this is all what I want to discuss with you from this chapter of money and banking. And in the next chapter, we're going to talk about monetary policy. So it's important that you have first understand this idea of what is money and how it works, what are the main functions of money, and then how the Bank of Canada works and operates. Because in the next chapter, we're going to talk about the monetary policy. We talk about the open market operations. So if you know these things, then you can understand those better. So thank you very much, and we see you guys all in our next chapter video. Bye bye.